Hi, and welcome to Homework Rant with Professor Elizabeth Keating. I'll be going through a homework problem from the Introduction to Financial Accounting by Horngren, Sundam, Elliott, and Philbrick, the 11th edition, which is the same sort of problems as is shown in the second custom edition for Boston University. In this video, I'm going to be going through problem 333. This problem will have you very carefully work on reading an accounting problem. It will have you work on trying to understand better the effects of errors on reported earnings and to consider how to correct these mistakes and misreportings. Errors is something that's very common in accounting, and yet it turns out to be a very frustrating kind of problem for students. So I'm going to talk a little bit about the errors and how you would go about correcting them. The first part of the problem actually presents an example, number 1, and the answers. So I'm going to start with number 2. And in number 2 it says that depreciation was not recorded in 2010, but it was reported correctly in 2011. So depreciation expense is an expense which lowers net income. And so if it was not reported in 2010, we have understated expenses, and as a result, the net income reported is overstated. The problem doesn't go further, but if net income is overstated, retained earnings are overstated. And then you might wonder, what's the other side? What's the other part of the effect? It's that the fixed asset value is overstated. Now this is where students often get caught up. You have to read carefully what's written. And what it says in the problem is that depreciation was correctly reported in 2011. So what that means is if the depreciation expense is correctly reported, it's the number that should have been in 2011 all along, regardless of the mistake. So if we have the correct expense in 2011, then net income in 2011 is correct. But you might ask, but we had a problem in the prior year. In this particular case, that problem was never corrected. So throughout the history of the firm, we will have retained earnings being overstated and fixed assets being overstated because we have not introduced into our books a correction for the problem that occurred in 2010. Now in part 3, what we're told is that the use of the office supplies was not recorded in 2011, and we're asked to report what happened, what was the effect in 2010 and in 2011. The expenses will be correct in 2010 because 2010 happened before 2011. So there's no effect on the income statement in 2010. However, if we didn't record the use of the office supplies in 2011, then the office supplies inventory is still high, and supplies expense was never recorded in 2011. So expenses in 2011 were understated, and the net income in 2011 will be overstated. And as we learned in the previous problem, when net income is overstated, then retained earnings is overstated. So the effect is nothing in 2010 on the balance sheet or the income statement, and in 2011 retained earnings will be overstated, net income will be overstated, and the supplies inventory on the asset side of the balance sheet will be overstated. In number 4, what it tells us is machinery was not recorded in 2010, but we're supposed to ignore the depreciation aspect. So machinery is missing as an asset on our balance sheet, and the associated depreciation presumably would also be missing, but it didn't ask us to comment on that. So it's trying to see if you understand the relationship between the income statement and the balance sheet. So when a piece of machinery is purchased, it's reported as an asset on the balance sheet. And so this is a balance sheet error, not an income statement error. So as a result, there's no effect on the income statement in either 2010 or 2011. So the final requirement in this problem is to look at rent. And so what it says is rent from the future is listed in the 2010 expenses and it's missing in 2011. So we're too aggressive in 2010 and report too much expense in 2010, and then we fail to show it in 2011. So we have overstated expenses in 2010, which means our net income is understated. Okay, so if net income is understated, retained earnings is understated. And if we want to think about the other effect on the balance sheet, what that means is prepaid rent is understated because we took too much of it off in 2010 and ran it through the income statement. So in 2011, rent expense is too low because all of the rent expense was in 2010, and our net income is overstated because expenses are too low. If we did put all the 2011 expenses into the 2010 income statement, we can now think about where we are in terms of retained earnings. So retained earnings first was too low at the end of 2010, but it's actually now been restored to where it should be at the end of 2011. Because at the end of 2011, the 2 years of rent should have been recorded, and they were. And so now if we think of our balance sheet position, we will no longer have too little prepaid rent sitting on our balance sheet. We'll have just the right amount. So that's what I wanted to cover for homework problem 333.